Welcome traders. In this video we're going to go over the new KP2 ratio indicator, and we're also going to look at what we can do about some of the volatility that is currently occurring in the market. And I've received several calls about what to do for the illiquidity, and basically what is happening is we have smaller numbers in the Superdome, and in the Superdome we don't get the liquidity and the logic that we really want to see when we have a smaller zigzag on the chart. So what I mean is this chart here is my standard 300 tick 2-point zigzag chart, and what we'd like to see is we'd like to see the ratios actually giving us really good information. But because of the illiquidity and the ability for the market to drop and then rise with very little contracts being traded, we have a little bit of a problem with that. So what I've done is I've gone and created a template which will be found on the blog. That template is for a larger zigzag of 5 points. And this is what we're looking at here. Now, the reason that this becomes important is because with a larger zigzag, we now have the liquidity numbers that we're looking for that will tell us some valuable information, and we can use the KP2 ratio indicator to our advantage. Now, you're going to see some red and green lines on the chart, and I've drawn those in. It's not the indicator drawing those in, so let's just be clear about that. Now, let's take a look at what we expect to see when we're using this indicator. So what we expect to see is we expect to see the ratio indicator basically following price. In other words, as price is selling off here, the ratio indicator is dropping, and that's okay. Now, this is the problem in the current market. If you'd taken a trade right here, suddenly we had these two large lot traders right here come in and take the market up to the intermediate resistance zone. And what we saw here is again what we expected. And as price goes sideways, the ratio indicator basically goes sideways. And I've put a number of 75 as what I'm calling my oversold distribution, and negative 75 as my overbought accumulation line. Okay, so what we want to see if we're in a trade is we want to see the ratio indicator increasing as it's doing right here. So as price was increasing, the ratio itself was increasing. And that's a good thing, because what it's telling us is it's telling us the density of the number of contracts between the low here and the high up here. So the number ended up being 95 at the peak, and as you see down here, the number was as low as a 35. So as price rose several points, the traders came in and provided additional resistance to that. And basically that's what sucked up all these large lot traders, is this additional resistance that was there. Now, this brings me to the next point, in that if you were actually trading this, you may or may have not gotten a couple points out of that, gotten filled and ended the trade. But if you traded this with micro contracts, you could trade a couple here, and then if price did trade higher, you're just out a few dollars instead of a few $100 when price would eventually get up to here. And basically the idea would be this, if you're seeing what is expected right here, then you can average down and take advantage of this distribution. We don't have to be right the first time. We don't even have to be right the second time. And we can still get a great trade out of that by using the minis and by having a larger stop. In order to do this, of course, what you have to do is you have to understand where your stop is going to be. And this is not trading advice. It's only pointing out that the minis could be used with less risk because they only are 1/10 of the E-mini contract. And like I said, it's very important that if you're going to do something like this, you go and you test this out. Now, let's look at what is not expected and what is not good for a trade. As we see right here, if we were thinking about getting long from this exhaustion pattern, which is a valid pattern to be taking, we can see that once we traded here and price got lower, the ratio itself moved significantly higher, all the way down from our 75 figure up to about 55. And while that's not a tremendous number, it's not really a good thing to have happen. So you would really want to be aware of that if you got into any trades, if you went and took a long trade from here. Same thing that's happening right here, except this one's happening on a much steeper incline right here for the ratio. And what happens? Well, we're only able to make it back to minor resistance, and then price again continues to drop. And that is repeated again right here. And again, we have only a very weak covering, even though back here, when they started to cover, they were covering at a very good ratio. And then as the time goes by, from here to here, they don't want to provide that limit order support. So again, what we see is we see an excellent sell-off here. And if we had entered here, we could look at this and we could say, okay, that's doing exactly what is expected. As the price is falling, the ratio is falling. And theoretically, we could add another mini contract here and end up with a good trade out of it. Now, this was something like a 60-point drop last Wednesday. And what ended the drop? Well, as we see from here, once we got down to here, we had a good ratio. The ratio responded with price, and then they drove it down one final time to run all the rest of the stops. Well, what happened when they ran it down? Well, the ratio itself increased, and that is what was expected. And then you can see we had almost over a 20-point recovery. As we look, here's another trade here that we see again where we first get our number at. It's not very good and probably not a reason to be taking a trade. But as we get down here to test this previous low, we see that we have a significant increase in the buyers willing to step in and provide support. Here we have an accumulation divergence trade, and it does exactly what's expected. We get the new ratio on this bar right here. It's a very deep ratio of approximately -100, and immediately it comes down. We get our divergence signal, and price goes up another 5 or 6 points. So that is basically how the indicator is used. Now, I want to fast forward to today, which was Monday the 18th. And if you're watching the market, you would know that the S&P rose about 90 points today. So it was a very strong news-related move. And I want to illustrate this big, large move up that started at about 10 o'clock in the morning. And what we see initially is we see a large number of buyers doing exactly, again, what we expect them to do. And then we initially get our first ratio. Now, what we don't want to do is we do want to treat these as exactly the way we would in our other trading chart. In other words, we don't want to trade into a strong trend. So what are we looking at right here? Well, right here, we're looking at as price is going higher, the ratio is going sideways, okay? And that is not a good thing. From what I've seen and experienced with the indicator, what you don't want to do is you don't want this indicator to be going sideways. Are they providing a significant amount of limit order resistance? Absolutely. The number is almost 100. But it was 100 this entire move higher of almost 25 points. So it doesn't make any sense to try to pick a short anywhere in here, especially with the ratio indicator just going sideways. Again, that's not what we want to see. We want to see it reacting with the price. We want to see, as price falls, we want to see the buyers stepping in and providing more support. And here, the sellers just continued to get run over. And then the other thing I would note here is that as price goes higher, we again have this divergence where the ratio is getting weaker. And when the ratio is getting weaker here, well, that just means that the sellers are stepping away with their resistance and the market is going to continue to rise. Now, the other interesting thing about the indicator is this, is that all of these are relative. In other words, I look at all of these in conjunction, what's going on up here to what is going on down here. And you can see that on this initial pullback, we had a very strong 209. Well, what I've noticed is that is always expected. So we basically had a 5.5 point pullback, and these are buyers on limit orders that missed this big 25 point run. They think it's going to be going higher and be going higher immediately. So that is very common, that we're going to see a very high number on the initial pullback. And then that gives us our exhaustion trade right there, which is good for a little over 7 points. Now, what we're doing here, though, is again, this becomes important, this 126 becomes important, because relative to the 49 up here and the 73 here, well, that is showing that there's more people willing to buy on the limit orders. So again, as we trade over here, as price is responding, we see this last little sell-off right to the edge of the counter trend zone. And what had happened? Well, as price sold off, the buyers stepped in on our limit orders, driving the number down and again giving us a 102. And then the market again traded significantly higher. We washed out all of the late longs up here, and then price resumed higher. We see the same pattern occurring again, where we had our first pullback, and our first pullback after this strong trend reversal was exactly to minor. and we had a good strong number here of a 136, again a 100 here, and a 97 here. Again, take all of this in context and compare it with what is going on up here. We have a 73, we have a 9, and we have a 101. So only really here did we see any significant resistance from the sellers, and again that got us a 6.5 point move down. But once we get down here and we start trading at around 29.51, we can see that we have very good limit order support, and once we trade to the eventual low here and start trading higher, the ratio starts increasing, which is expected. So if you analyze this and go back and look at your charts at the end of the week and try to explain why what it's doing is doing it, that's basically how you're going to learn how to use this indicator. You can see here that as price was getting higher, the ratio itself, as it came back down here, was continuing to dip. And that indicates significant buy-side limit order support as price fell back into here. So that's something that we want to be aware of also. And here is one more example. This example is from last Wednesday. And here we see that price made its high right here. And this number really wasn't a great number that we would be wanting to step forward and be a seller like it was back here. But what we see is price sold off, and we're only down basically about 6 or 7 ticks. We see that as price was selling off, the ratio was again rising. So I wanted to point out that it is important that you go back and you look at this, and then that led to a trade that was worth over 10 points. And it's very important if you can pick that up in real time. So I'm going to create a web page under the trading strategy for this KP2 ratio, and I'll be doing it this week, and there will be additional information there. But if you should have any questions, be sure to give me a call. And again, the idea with trading the minis is not trading advice. It's only a consideration that you give so that you're reducing your risk by trading the E-minis. As with anything, you need to go and prove out that strategy before you go ahead and attempt it. So everybody stay safe and have a good day. See ya, bye.